Everybody, welcome to another episode of Still Searching with Jed Morris. Today, my guest is Jonathan Hutchins. He's the senior manager at Ascenti for corporate strategy, M&A due diligence, finance, and process improvement. Jonathan, he basically does M&A finance due diligence. He works with deals as small as a couple $100,000 all the way up to 50 million to 100 million, all across the middle market. And so I'm really excited for Jonathan to be here and to help just talk to us a little bit about what it's like in financial due diligence and the things we should be looking out for. So thanks for being here, Jonathan.
Thanks, Jed. Yeah, appreciate the introduction.
Yeah, well, I'm excited. How about we just start off with you letting us know a little bit about your background and how you got into financial due diligence.
Yeah, so I'll go way back. I was born and raised in Tulsa, Oklahoma, and then went into audit services out of an accounting degree. Started realizing that the sort of the nitty gritty of accounting was interesting and a good foundation for my career, but really wanted to get into the more interesting side of the world. And I actually did a multi-billion-dollar carve out when I was at EY in audit, and I was like, this is so fun. I want to do this. So that was my first introduction. I did on the audit side, but that was my first introduction into the kind of the finance side of it and the Q of E and sort of the carve out audit world that I did. And so that kind of got my wheels going. I started looking around and realized there wasn't financial diligence practices in Oklahoma. And so I ended up, shopping around, ended up finding a home at EY in Atlanta, and made the move out here back in 2019. So I did 4 years, 4 busy seasons in audit, and then made the move over, which is a pretty traditional. So for folks who are sort of learning about financial due diligence, a lot of those folks come from audit. Some of them are kind of the CFE, CFA role finance backgrounds, but call it 90% are CPAs by trade, accounting by trade, and then they move into financial due diligence, kind of a natural role, similar to almost like a move into FP&A.
Yeah, that makes sense. And you have your degree in accounting, but you didn't get the CPA, right?
I did get a CPA, yeah. So
okay.
Yeah, so I'll rewind a little bit. So I did a bit of an atypical move, which was instead of getting a MAC or a master's in accounting, in order to get my hours for the CPA, I just decided to get an MBA, but did it straight out of college. So I didn't, I didn't do what people should do, which is like go get 2 or 3 years of experience, go to a big school, and then have that school launch you into something else. I just went straight through and then basically came in as an entry level individual with an MBA, which in hindsight was rather silly to do, but it worked out okay.
It seems like it worked out okay. And so now you're in Atlanta, and you basically made that big pivot, getting you into deal sourcing. Because I hear this a lot too, and to be honest, that happened to me. It's like once you get that first taste of like how deals are done, you're like, oh man, this is cool. this is really great. And so you kind of got bit by the bug, went to Atlanta, and now you're just neck deep in deals.
Yeah, so I really dove into it pretty blindly. I mean, I hadn't really worked with any core diligence folks prior to that. Even when I did the audit side, I hadn't really touched on it. So I got bit by the bug a little bit then, just basically dove in and just was like, this is what I'm going to do. And I loved it, right? I very quickly learned that that's how my brain kind of ticks and operates, and that's how I think about the business world is in a little bit more of the finance, a little bit more of the strategy and operations side, which I think is what a lot of those practitioners in the world of what I do need to be able to think about beyond just the debits and credits of the accounting, right? They need to be able to think about like how does that actually translate into operational outcomes, and how does that impact sort of your P&L and the business balance sheet and cash flows.
No, that makes a lot of sense.
I loved it, and no turning back since then. So,
no, you're exactly right, and I think this is the part that like a lot of people miss, and it's one of the things that Oswald Demoter, the valuation professor at NYU, talks about a lot. He's like you have your quants and you have your storytellers, and the quants want all the numbers to make sense so they can have a rational explanation, and the storytellers, they ignore the fundamentals completely and just tell you about how great the where the business is headed. And he's like, the true answer is that it's actually a mix of the two. You have to have the financial foundation, but then if I don't understand your story, then the finances don't make any sense. And so you have to actually find a way to combine the two and figure out like what's the true story of this business and where is it actually headed? Because neither of those two, the storytelling or the financials in isolation will get you there.
Yeah, and that's a great transition into sort of the world we live in, right? So you have the investment bankers who are the storytellers, right? And then you have you have the sort of the controllers and stuff at the business who see the numbers, and then we sort of slot in the middle of like, okay, how how does these, glorious pro formas in the hockey stick of the business hit reality, right? And how does that translate into both a forward-looking view as well as how the business has performed historically, and is the way that business has performed historically actually align with the way that the bankers are sort of articulating? And I say bankers, I know a lot of deals are unbanked, right?
Right.
But even in the lower middle market space, I feel like there's still a lot of investment banked deals, even if it's a smaller bank firm, right, versus a Baird or a Goldman or someone else, right? There's still kind of lower middle market banking providers who try to tell the same story of your business. Yeah.
Yeah, we really see that, and you're right. You don't really see the bankers involved in like the SBA level deals, but
Right.
once you get over that 5 million EV, then they tend to start playing along a lot more,
Yep.
because they can do that. They help tell that story. So let's actually dive into that piece right now. So now you're doing financial due diligence. You're helping small businesses understand how to tell the story of both their finances and the direction of the business, whether it's because they're being acquired or it's a larger business looking to acquire another. And a lot of these businesses, what's the range you're working with? Like, what's the smallest types of businesses all the way up to the largest deals?
Yeah. So I think, smallest, I'm working on a deal right now. It's 300,000 EV. It has about $1 million in sales.
Wow,
That's,
that's small.
yeah. So we'll go as small as that. I've done maybe one or two deals smaller than that, but that's about as, if you go much smaller, your risk to fee ratio starts compressing quickly. And then, as high as deals of, pretty common to be in the 50 million range. But I'm working on a couple, in the last couple of months that have been close to 100 million. But that's kind of the spectrum. Call it really 5 million EV. So kind of that 5 million kind of above the SBA level, right? All the way up through, $50 million is a pretty common range for my firm.
Yeah, that's a pretty broad range. And the big takeaway I have is that, if you're working on deals that are like, on the smaller side, whether they're SBA sized deals, like $1 to $5 million, or even like a $300,000 deal, like you just mentioned, all the way up to 50 million. Now that's still squarely in the middle market, but they feel like they'd be a lot different, right? Like if you're working on a small, like, 300,000, $2 million, total size deal and a $50 million deal, they feel like they'd be a lot different. I mean, are they? I mean, are they really that similar?
Yeah, so I would say the thing that really drives the complexity, I would say, is the industry less than the deal size, right? And so within
Oh,
specific
okay.
industries, you'll see, manufacturing, right? You have cost accounting, you have complexities there. Within software, you have the quality of revenue, SaaS implications, right? Within deal size, you see less difference. Honestly, the smaller deals, you typically have a less sophisticated accounting background
Hmm.
running the business. Oftentimes,
QuickBooks, if you're lucky.
QuickBooks, typically like the wife of the owner or the owner
Right.
themselves, or the husband of the owner. If the wife is the owner, it doesn't have to be, right? It can be both ways. And you get lucky. They may have been an accounting degree in college, and you're like, sweet, these books are in order. And you may get lucky, and they have no idea what accounting is, and they're just putting things into QuickBooks, the way that QuickBooks says they should be categorized, which is, okay. So, obviously, as you get more volume of customers in a deal, complexity does increase. But the issues around revenue recognition, quality of revenue, you're validating that you're actually getting cash in the door, the nuances of looking at headcounts and kind of the other SG&A components, looking at your margin by customer, all of those things exist at both a small business and at a large business.
Okay.
Yeah.
That makes sense. It seems like, as I'm thinking about it, it's like it would feel like a small deal, dollar wise would be a lot different than a bigger deal. But in reality, it's not so much the dollar size, it's the industry. And that makes sense. Like some industries are heavily regulated. Some, like you mentioned, manufacturing have a lot of cost accounting. I can think of like healthcare feels like it'd be one that have a
Right.
lot of regulations as far as like, the type of information that you're tracking. But yeah, it's less about the size and more about the industry. Interesting.
Yeah, and I will say, I mean, obviously, if you're working with a business that has 50 customers versus one that has 5,000,
Right.
there's going to be a time differential in how quickly you can get through it, right? So the one that's 50, that's a small business, or ironically, you could have, a 50 customer that's huge in revenue because they're really big customers. But assuming the small business is the one that has 50 customers, you're going to be able to get through the work, on a quicker time scale than you would if you're analyzing, a 5,000 customer business and you're looking at concentration risk of that, and you're looking at price volume analysis across it, and those other metrics. There's definitely going to be more of a lift for a bigger business if you're thinking about the duration, the intensity, and the fee related to it. But there is kind of a baseline minimum, right? You have to do on every single deal, and that baseline, is here, and then you can have deals that range anywhere up and down from there. So,
well, that makes sense. Let's jump right into that then. Let's assume in financial due diligence is one of the areas that especially first-time buyers have a lot of questions about, obviously. It's like we understand that there are other important things in due diligence, but finances are kind of like the bread and butter. They're the foundation. You need them to be able to do the deal. Like that's the basics. And regardless of what people say, what I have found is that the vast majority of buyers are, they're not very sophisticated when it comes to finance. And what I mean is that, the best ones have a pretty good understanding of revenue and gross margins and net income and what their EBITDA looks like and how to, track all that. Talking finance, most people kind of shy back a little bit, and you're nervous. And so I really want to dive into this from the perspective of, hey, I'm a first-time buyer. I understand some basics of finance, but I'm not a Wall Street guy. I'm not a deal guy or gal. And I want to make sure that I can understand some of the basics I should understand as I'm working with a professional. Because I'm not, if I'm buying, I'm going to work with someone like you or someone who's providing a quality of earnings. And so I understand it's not going to be me, diving through the numbers, but I also understand that I'm ultimately responsible, right? So I have to understand what you're telling me, because I'm the one who's going to fundamentally make the decision whether or not to buy this business or not. So let's look at it from that perspective. I'm a brand new buyer. I've got a decent understanding of finance, but I'm not a pro. I definitely don't have my degree in accounting, and I've not worked in M&A due diligence. So I find this business. Let's say for argument that it's on the high side of an SBA level. That way it's not super tiny. Let's say it's $4 or $5 million enterprise value. What are the first things, like what are the foundational things that I should be looking at, or that you're going to be looking at as you start looking at these deals? Like what are the bread and butter?
Yeah, so assuming they're in sort of target identification stage, pre-LOI, right? You want to be looking at a couple things. One is, how has it trended historically, right? So what is top line revenue done? Like is it producing? Is it growing? Is it shrinking? Is it flat, right? Step number one. Two, what is its gross profit, right? Because gross profit is super important. Like you can only cut costs to a certain level in the SG&A side if you don't have a high enough level gross profit that is, at or above industry average. So one, you need to be able to have someone you can call on in the industry who knows what the gross profit should be, right? Because you're like, oh, it has a 50% gross profit, but it should be at 75. You're like, 50 sounds great, and then you're like, oh wow, this should be at 75% gross profit.
I see that a lot in services too, because you'll find businesses that have a gross profit of like 25 or 30%. And you're like, oh, that's actually not so bad for HVAC or whatever the business may be, until you actually speak with someone who's in the industry and like, it should be closer to 50, And so the question then becomes, is it not at 50 because the business itself is being mismanaged, or is there some sort of underlying problem?
So that is a very interesting question, because it can sometimes be as simple as they're not putting the right cost within cost of goods sold.
They haven't increased their prices in 10 years.
Well, it can be two things. One, it can be they haven't increased their prices. Two, they haven't managed their vendor relationships. Or three, they're coding things to COGS that should be in SG&A, right?
Oh, that's a good one, yeah.
And so it really can be. So then the next step is like, what's your EBITDA contribution, right? What is your what's your gross profit down to what's your EBITDA? And if you're generating like a 2%, margin on the bottom line, you're like, okay, well then not only is COGS probably under what the industry should be, there's probably also a lot of excess SG&A that is also an issue, right? But if they're like, hey, our margin's at 50%, it should be 75, but from the gross profit down to your EBITDA contribution margin, you're like, hey, I'm at like I'm at 50%, I'm at 30%. You're like, wow, like 30% is phenomenal. That means it's probably just a lot sitting in COGS that should be down in SG&A, right?
Yeah.
Um,
And that's actually what you want to find. You just
exactly.
misallocated,
Yeah.
how you're actually, writing in your costs because, that gross profit, we're supposed to be removing all the SG&A. We're supposed to be saying, hey, this is the profitability of business operations. Assuming everything else is going fine, this is the profitability of the business itself,
Right.
outside of like all the admin stuff that I need to keep it running. And if I'm putting that admin stuff up in the cost, then it could be, a much more profitable business. I'm just not accounting for it correctly, which makes sense because we know that a lot of small businesses, you know, their books aren't great. And even if they are decent, they are, like you said, they're probably an owner, an owner spouse, or, some or bookkeeper who could just be simply putting those costs in the wrong place.
Yeah. Yeah. And what you'll find is you'll find it going both ways, right? Where people it's mostly people, right? So if it's a materials business, materials purchases generally end up getting it in cost of goods sold, but sometimes they'll just throw all the headcount costs up in the COGS, or they'll throw all of them down in the SG&A. And you're like, okay, look, really, like your controller and your office manager, and thinking about sales and marketing, right? Like sales and
Yeah.
marketing should be in G&A, or broadly, right? You could have a sales marketing group, but I'm calling G&A everything below gross profit, not up in cost of goods sold. Um, Cost of goods sold should be the people actually, if you think, the HVAC business you mentioned, I think that might have been the example you gave, right? It's like your techs are the ones that are up sitting in there, and your
Yep.
your sales folks and your area managers, those might be down in G&A versus up in cost of goods sold.
Yeah.
And that's where folks like myself can sort of provide a bit of like a benchmark based on what we've seen in other deals, what we've seen in the industry, of where cost should be, and then is this above or below where we would expect the profitability of this business to land.
That makes a lot of sense. And to be honest, I think a lot of businesses categorize that incorrectly. And I think about like, I owned a landscaping company at one point, and a lot of blue collar service businesses, labor is the number one expense. It's the number one cost
Yeah.
by a long shot, and supplies are expensive, but labor is by far the most expensive. And almost always the labor is either completely up in COGS or completely down in SG&A.
Yep.
Very rarely split. And
Yep.
so if first of all, if you don't realize that those should be split, then you're not getting a clear view of your profitability. And then second, once you realize that they should be, as you're getting those, if you're a buyer, as you're looking at SIMs or as you're talking to business owners and you're looking at their financials, like you got to do the diligence ahead of time, pre-LOI, if you can get the financials and just be like, all right, well, what do I think the actual what is the actual profitability of the business? Like
Right.
it's clear that, because they've misallocated the largest expense, that they have a skewed view, and that could give me an advantage because now I know what this business is actually, how much cash it's actually generating.
Yeah. And so going back to your original question, is like, what are the things you should be looking for, right? So um, it's what is it? What is a diversity in product offerings, right? Okay, are they concentrated with one specific service? Okay, maybe that's good, maybe that's not, right? Like, where is the revenue coming from? Can you get a customer listing, even if it's redacted, right, to know customer concentration? And then the ability to get gross profit by customer to see if there's an anomaly in there, to understand if a specific customer is really driving a lot of their EBITDA.
Yeah.
And then from there, a lot of these small businesses, I want to know who's a day-to-day GM, like who's the person actually out there, boots on the ground, driving customer relationships. Because if I'm coming, if I think of like an ETA model or some of these other models, even a private equity model, right, where you're either wanting to transition an owner out, or outright replace them within a short period of time, you want to know. And I've seen this on deals I've diligenced on the buy side, where they did a bunch of add-ons and they didn't properly identify who the sort of key man was, and that key man departed, and
Yeah.
then relationships went with them, and then
Yep.
they realized that after the fact, right? And they're like, well, why is my business shrinking now? And this was there was a property maintenance company I did diligence on that ended up dying. And it was sort of a conglomerate that rolled up a bunch, and they had a couple, I would say, happenstance, where they had a couple ones where the second in command was actually the one that could step into that relationship, and the other ones that there was no second in command. And when the primary owner sort of phased out, they just started like revenue was declining 20% year over year, declining,
Oof.
which is, not the direction you want to be going. And then, on top of that, they didn't have a good handle on margin by product or by category. And so we came in and we're like, guys, look, like these are all the flags we're seeing, like, and not only is it shrinking, we can't even tell you to our client, we can't even tell you what their profitability of the product lines they do have is because the data doesn't exist.
Yeah.
I mean, that's a whole nother story of like deal readiness and everything that goes into that. But
you're hitting on something critically important, which is the key man risk. And a lot of times, we think about the owner being that key man risk, which they absolutely are.
Right.
But you also think, but the very next thing is like, which of the key employees are really important? And this is something that's really important, especially like, for all the reasons you just mentioned, relationships go with them, profitability goes with them. But also when you think about how first-time buyers, a lot of times they're buying in an industry they don't have direct experience in.
Right.
And so not only are they, when they buy, now they're buying in this industry, they don't understand the industry, and they're learning about the industry. And at the same time, learning how to be an owner for the first time, which is its own, vicious learning curve. But now they've got, if they've properly identified one or two key men like or women, like key positions in the business, and they're kind of stuck with them. Like they have to really kind of like nurture those relationships very critically because, like you said, one or two of those people leave and now you're stuck. And, especially if you're buying a business that you don't have experience in, it's going to be much more difficult for you to roll up your sleeves and do that work yourself.
Yeah. And so that's a little bit, so I mentioned that it's a little bit outside of the wheelhouse of a QB provider, but I put on my operational hat on every deal, which is like, what are the risks outside of the core financials that I want to be, telling my client about? And so, a lot of these smaller deals, so the sub 5 million EVs, it's going to be 3 to 20 people at the business, right? So it's going to be small, kind of a small core group of people. Likely we're going to be talking to the owner, maybe the owner and a plus one, right? But those are the type of questions that are like, hey, like, what does your day-to-day look like? Are you out in the field? Like, what is your mix between administrative roles and client-facing roles? Like, those are the type of questions that especially the smaller deals that we'll kind of throw into our kind of core question list that we wouldn't necessarily need to do on, 100 million EV type deal because they're going to have a president, a VP of sales, like a suite of people who own the relationships that you can just give them a retention bonus or whatever if you need to retain those. Whereas on the smaller deals, it really might be that one person who owns that versus a handful of people. And if one of the handful leaves, you can sort of absorb that into the remaining group, but not so much on one of the smaller deals.
Yeah, exactly right. So let's run these down. So first, you mentioned how, checking revenue direction. Is it trending up? Is it trending down? Is it flat? Checking gross profitability. Like, is the operations of the business actually producing money? And then are the costs aligned correctly so that we actually get a clear look at gross profitability?
Right.
Key man risk, making sure that we understand like who's actually got the relationships, where the actual profitability of the business is being driven from, and identifying that person correctly. Because you're right, the last thing you want to do is buy a business and then all the customer relationships, the supplier relationships, the vendor relationships, all of those walk out the door as you're taking the keys.
Right.
Man, I could definitely see that happens a lot, especially like a roll-up type deal where you're just buying quickly and maybe not checking for those key individuals as thoroughly as you probably should.
Yeah, and I'll add one more item, and this more sits in the G&A portion, but how married, for lack of better words, is this business with the owner's personal expenses?
Yeah.
Right. And so there's two risks that exist there. One is, and this is almost a risk that sits more on the seller's side, but it's like, is EBITDA as reported understated, right? Because there's actually their private yacht, that's a real example, or other things.
I met an owner who had a jet in his as an ad back because it was a manufacturing company that manufactured airplanes, like test planes, and he had his own plane. I get it.
Yeah. No, I'm not going to digress too far, but I did a deal out of California, and he actually had a yacht with a captain on payroll and a crew all on payroll. That it was a larger business.
That's a great life to have.
Yeah, it was a great life to have. Yeah, he did very well for himself. It was a steel business out west. and they did, a lot of the larger skyscrapers and buildings and things out there. But yeah, like is EBITDA as reported understated, right? And maybe the owner doesn't even think about it, and so that's a potential upside to a buyer. But um, the risk you could run is that you do an LOI at, let's just say, 500,000 of EBITDA, and then you get in and you start asking questions, and the owner wises up and realizes, oh wow, I actually have $1 million worth of EBITDA, and they try to reprice, right?
Yeah.
Or you do your homework up front, and then you could know going in, hey, this is really what the purchase price is going to be, more ballpark, right? So that's always a question you want to ask kind of up front of like, I'm not a tax, I'm not the IRS, right? I'm not asking from that standpoint, which that's a whole nother set of questions. But uh, you know, do you run your Amazon account through here? Do you run your personal cars? Do you
Yep.
all your groceries, your vacations, right? Like, and the answer more frequently than not is yes, we
Yeah.
do. And then that's something like myself can untangle all that, because it is very oftentimes it's very much just booked in with everything else. And
Yep.
so you'll have a dozen or more GL accounts that have personal stuff just, you know, completely interwoven into it, and you have to pull it all out.
Well, and that
Um,
makes total sense. And you see it all the time, especially in the smaller deals, the 5 million and below deals,
yeah,
because you have every tax incentive to do it. And if you're a small business owner and you're not running as many of your personal expenses through the business, I would argue you're probably not taking advantage of your opportunity. Um,
right.
but that's where it comes really, you have to be really, really clear about like, which of these items is an add back and which one isn't. And
Yep.
then one additional risk, and I love how you talked about like the yacht, right? And like, hey, this could be understating EBITDA by a lot. Well, the flip side of that is, like if you have something like an airplane or a yacht or a sports car, and maybe the owner has been, it's the owner's, item, but then they've been using that as marketing. And maybe that's one of the ways that
Right.
they're getting a lot of like their business relationships, like, hey guys, come out on my yacht for a while. And that's
Yep.
how they're making those deals. Well, then maybe EBITDA is overstated. So as the buyer, you kind of have to be wary of like what are these ad backs and how are they really impacting the business, and that's an asymmetry of information that you a lot of times you just don't have.
Yeah, no, you see that a lot. Like one of the things I always like asking, even when I see like donations expense, right? You're like, okay, well that might be it's what you consider just a no-brainer ad back, but it's like, well, are you getting advertising at the galas, right? Or are you doing different things? And like the answer is often yes, right? And so it's like, okay, well, maybe that's not a full ad back. Maybe the one going to the local college, maybe that one is, right? But the one that's going to the chamber or something, something where they're like up on the parade, right? Like, and there's a
Yeah.
banner out there, that one maybe not, right? And so, yeah, great. It's a perfect example, Jed.
Okay, so that makes sense. So these are the foundational things that as a buyer I should be looking for. What are some critical red flags that I should pay attention to? And maybe they're not like, deal stoppers in of themselves, but what are the things that when you see them, you're like, okay, that's a red flag. We have to get an answer on that right now because it could be a deal killer.
Ooh, that is a there's so many things that pop into mind. So, uh, yeah, I'm going to give a couple maybe examples from a recent deal, but I mean, one is is the data different than what management told you, right? So like that's one red
Yeah.
flag, which is, oh yeah, we're like, I'm going to I'm going to change to a different thing. Like, so I'm going to go to SaaS. So if we're like, hey, we're in a software deal. Oh yeah, we're growing, great retention. We've had minimal churn, right? And you get
Yeah.
in, you're like, guys, you're having crazy churn, right? Okay, big red flag, right? So it's like if the data doesn't line up with the narrative that management told you, regardless of SaaS, whatever, any industry, that's a red flag.
Yeah, because the question then is like you have to put your EQ hat on and you have to think, is management lying to me
Yeah,
or do they not understand how to track their own data? And both of those are red flags.
yeah,
Obviously, in my opinion, if the owner or the manager is lying to you, that's a I will not move forward. That
yeah.
tells me that there's bad faith. And if there's bad faith in one place, there's bad faith in other places, and this is not worth the risk for me as the buyer. But the other part of that is like, if their story isn't matching the data and it's because they don't know how to track it, then I'm like, well, I have a whole another set of questions. Like how much of their other data is just tracked incorrectly? Are they really that incompetent?
Yeah, and so I feel like a lot of the other flags we'll get is oftentimes when there's like a sell side advisor involved, and so these would be a little bit bigger deals, but and these are more like called yellow flags,
Hmm.
which is where we're getting, and these are things we raised to our clients early on. We're getting in, and so they probably priced an LOI off of another provider's EBITDA, and we get in, we're like, guys, look, like one, either the other provider said did not diligence management's estimates of something, right? And you're like, okay, well, clearly they didn't diligence it because there was nothing to diligence, right? So that's a super squishy adjustment.
Right.
Or you get in and you realize things are just very seller friendly, right? Where, I've a recent deal I did, there was a upcoming restructuring that was going to happen, and it was like $1 million add back on like a $10 million deal. Um, and
That's
so,
material.
right. And so, like, we're like, hey, you can get credit for this, but they better have actioned it before you guys close, right? Um, and and ideally actioned it where you can see that the business can operate for a couple months under that before you guys close, right? And so,
Mhm.
and that was an add back that, they had on the seller's Q of E item, and we evaluated it. It actually it was supportable, right? Like the heads and the numbers all matched up. But that was, it was maybe not like a yellow flag, but it was like, hey, this is something that we would want to raise of like, if you're valuing off of this, like, so things that are in a Q of E that have yet to be actioned, right? That are
Right.
put in as if they're supportable, are always, something that raised a little bit of a flag to me. Um,
That makes a lot of sense. And I just realized that we're talking about, red flags that you find in the Q of E. Now, what would you say to buyers who are trying to decide whether or not they want a Q of E at all?
Yeah, so I mean, I would say unless you're someone who is a former sort of practitioner in this world, aka someone who's done due diligence or is a former investment banker and has done deal models and things like that, and understands it very deeply, you should be partnering with someone who lives in that world, right? Because it's just a different way of thinking about the financials that most people don't have the time to do when they're sort of evaluating a deal from a um, as a buyer's perspective, right? They're having to negotiate the purchase agreement. They're having to, keep the seller happy. They're having to think about the operating model going forward, thinking about integrate, like all these other things that where their head is at. They don't have typically the time to dedicate to truly do a deep dive into the underlying financials.
Yeah.
50%, well, maybe 70% of the time, the EBITDA will end up checking out about where you thought it was, which is in my mind, okay, that's actually good, right? It's like it means
Right.
the
You
business
verified the
actually
cash flow.
correct. We actually
Yes.
verified it. And like that's what you want, right? Um, and so, some people are like, well, it checked out, so I didn't need to hire you. And I'm like, no, you hired me for the 30% of the time that it doesn't check out, and you're gonna get, for lack of a better word, screwed if you don't hire the person, right?
I love that you
Um,
said it like that, Jonathan, because that's exactly the conversation I have with searchers. And I understand it. I was a self-funded searcher at one point, where I had some cash, but I was really leaning on the SBA as my primary debt vehicle to buy. And when
yeah.
you do that, you're always pinching pennies, and you're terrified of dead deal cost. And but what I see now a lot of times, and I'll be honest, I was in this camp too. When you're so okay, you're so eager to sign on the dotted line for 3, 4, $5 million of personally guaranteed debt to buy a business. But the idea of spending 20, 30, or even $40,000 out of pocket for a Q of E to make sure that business is actually what you think it is, like it's so hard to get over that hurdle. And I tell people now, I'm like, look, if you're not in a position to pay for a Q of E, then your whole philosophy of risk is incredibly skewed. Like you'll sign for all that debt, but you won't pay for a Q of E. Like, do you realize like $4 million of debt hanging around your neck, personally guaranteed, but you won't spend 40 grand to figure out if it's actually legit or not?
Well, and I'll tell you what. So I almost say I'm making this number up. Let's say 8 or 9 times out of 10, we'll end up paying for our fees in true value given back to the buyer. If that's an identification of an item that should be treated as debt as a reduction to the enterprise value, assuming so taking a step back, right? So QV, networking capital, debt, right? So depending on the structure, if it's an asset deal or an equity deal, and sort of if they're, they may or may not have a working capital construct, right? But between QOV, working capital, and debt, there's oftentimes a $40,000 item will identify in debt that, boom, fees paid for, right?
Right.
And then there can be a QOV item. It's sometimes a QOV you won't reprice, right? So it depends. A QOV is one where there can be less intrinsic direct value to a buyer, because if you're like, hey, we thought EBITDA was 2 million, you're like, actually it's 1.9, they may still go through and buy the deal at 2 from more of like a handshake kind of agreement standpoint, even though maybe they'll shift some of it to an earnout, or there's other ways to structure it, right? But you'll see you have to usually have a pretty big miss from an EV standpoint for someone to restructure the deal, because if you try to retrade after an LOI is signed deep in the diligence, it's sometimes viewed
you burn
as
a lot of trust doing that.
Bad faith, right?
Yeah.
Exactly. Yeah. And there's obviously two sides of the coin there, but you definitely see more direct EV impacts from a debt standpoint. I'll give a great example, and this would be on an equity deal, where we, through our diligence, learned they had recently changed their practices around vacation, and they had gone from let's call it 120 hours a year policy to unlimited, but they had grandfathered in all the people, so they still had the old amount that could be paid out upon departure. We were able to negotiate that as debt, the full amount of that, like dollar for dollar.
Oh, that's great.
And that paid for our fees like 3 times over.
Yeah.
And so it was like, I can remember it was in the hundreds of thousands of dollars of accrued vacation that was sitting there.
Which essentially is just a line item for accounts payable. You agreed you were going to pay it, and so you can add that into the actual enterprise value of the business, and then you're like, well, that account payable that you were able to identify and agree is 3 times more than our fee.
Yeah, and
that's great.
Yeah, and it was funny because ones like that are like, that's a gray area. So like from a diligence standpoint, I've seen those go both ways, and I've negotiated them both ways. But we threw it on the table and we're like, hey, we told our client, this is gray. They should likely be giving you some fraction of it up to the full amount. And they took the full amount. And they just said, the seller said, okay, we'll pay you for that. And we're like, cool.
Yeah, and that makes total sense. And it's like that. That's a great example, but I tell people all the time, it's like, these types of deals, especially in the lower middle market, it's the wild west of capitalism. Like it's whatever you guys agree to. And so, the seller and his and their advisor, they have their idea of the financials of the business, their own, if they've done a valuation, they have their own idea. It's up to you to have your own, so that you can come together and find out, what are the things that each side is willing to trade on, and figure out like how you can get a deal done. And I really like how you talked about how, like, there are some things here that we can make a deal on. We can say, all right, well, all this leave that you promised to pay your employees, we can negotiate that as debt, and that way we can help pay ourselves back in the actual price of the business. But then on the other side, you're like, all right, well, although all that is true, you're also managing the relationship with the seller. Like, you don't want to get to a point to where, like, if your Q of E is off by a little bit, then is it really worth retrading the deal? Are you skipping the forest through the trees? Like, if you're like, hey, maybe we don't agree, and maybe the business is worth a couple $100,000 less than I thought it was, but I'm gonna get that EBITDA once I'm able to buy. Like, really, what are we actually buying here? It's a great analogy I saw is like, we were going to buy our home in San Diego during the pandemic, and the home price was $900,000, right? And so we're going to buy this home, and we had a couple things go back and forth, and we knew we wanted the house, and the seller was like, hey, 920 is our price. And I remember thinking, that's okay, cool. I'm not going to argue over 20 grand on a $900,000 purchase, because it's like an extra $1.20 on my mortgage. Like, this is not material. There's no point in arguing over this. So don't miss the forest through the trees when you're looking at, it's not about scraping by every individual penny. It's about really getting a grasp of the actual financials of the business, so you can have a real conversation about like what is valuable and what is not valuable.
Yeah, no, I completely agree. The one caveat to that will be if you have a seller who is well represented, meaning they have a really good transaction attorney and a really good banker and a diligence team with them, you want to make sure you come equally armed, right? And I've seen deals where one side was sort of David and Goliath analogy, for lack of better words. And, you know, I could see one side just pushing around the other, right? And so that was back in my EY days, and it was a huge client, and EY is a huge firm, and we told them, look, they're pushing you around, and this was an EY client at the time, and but they were okay with it. They wanted to get the deal done. They were willing to get pushed around a little bit and lose a little bit of value to get the deal done. And they ended up doing the deal and probably losing tens of millions of dollars in purchase price because of it. But they got the deal done, and they were, I guess they were okay with that. And we advised them repeatedly throughout the process of like, look, guys, you're conceding here. You should hold firm. You're conceding here. Market is this, and they're asking for this. You should push them back down to market or even under market, right? And so that's where being well armed from an advisor is they can tell you, hey, what the other side is doing is atypical to market. They're pushing you in a way around debt, around restructuring the earnout or retrading something late in the game, or even how they're structuring the purchase agreement that is not in line with market, that is detrimental to you. And hold your ground. Do not give on this, because this is an area that you can get burned if you give on it, and they probably know that, and that's why they're pushing on it. And so that's where not just myself, having a suite of people around you, not just an attorney, but a transaction attorney, right? And then to the extent you need a tax advisor, and to the extent you need someone like myself from the financial standpoint, at least those three on any given deal, to me, even to a small degree, right? Even if you're only consulting for a few hours, right? You should have those folks around a deal structure.
That is such good advice. I feel like that portion alone makes this entire conversation worth it to the listener, because you're exactly right. I mean, especially if you're a first-time buyer, like if you're going into the transaction, you need really good financial analysis. You need to come to the table armed, so to speak, right? With a great Q of E, good financial analysis, an excellent transaction attorney. I'm glad you said that, not just an attorney. You need a transaction attorney who does these types of deals in this type of market for your type of client. That way they're well versed in what they're doing. You need to understand your tax strategy. But the thing is, like, you bring these people in because they're experts. Right. But that doesn't abdicate your role as the buyer. You're like you said, you're the one making the ultimate decision. Even when you're EY, you're like, hey, they're pushing you here, they're pushing you there. If you don't educate yourself as the buyer to understand what is market, what is correct, what I should be expecting, like how all these deals come together, then your seller can very easily push you around, and half the time you won't even realize it. You'll be so eager to get a deal done. I see the deal fatigue happen quite a bit. Like, oh, this is a great business, I just want to get this done. And I'm okay with giving up a little bit of value to get the deal done, but then before you know it, you gave up like a couple $100,000 in working capital, and you're like, and you're dead on arrival.
Yeah, and so that's where as you're getting down to what I call the 5-yard line, there comes a point where me as an advisor, I'll start telling my client, look, I've given you all the advice I can give you. Now it's commercial negotiation. It becomes a point in which it is truly commercial negotiation, and you have to just gauge how you can get the deal done. And so there is a point in which that just needs to happen, right? Because if everyone is always just, quote, holding their ground, you literally will just have the parties walk away. So to me, it's hold your ground hard as long as possible until you get to the point where it's like, hey, we're at the 5-yard line. Someone is going to have to give somewhere. And you just hope it's, on a small thing, not on a big thing. And you just, get the deal across the finish line. And that's where, you can lean to your advisors to guide you on how much value am I truly giving up. Maybe it's not even a quantifiable amount. Maybe it's an unknown future something. Maybe it's, a change to your structure in the earnout of, what does this implication have, or a change in how you're structuring, the tax stub period, or I have a whole bunch of conversations around that of like, if stuff is done pre-close, post-close, which period it goes into, right? And how people can finagle with, pre and post-close tax returns of being advantageous to their, their taxable income and things like that. But there's all kinds of fun ways that advisors can work with you to make sure you're protected across the board, in any of those capacities. And one piece of advice I would give you is, if you're negotiating, when you get to the final portion, you've gone through the QOV, you have a buttoned up working capital, you know what your debt like items are, have your accounting advisor also look at the purchase agreement, because and even if that means they only look at the accounting and finance definitions, right? Look at how indebtedness, cash, working capital, and the purchase price are determined, and then look at the flow of funds. And those are, I would say, most clients do a pretty good job of passing it along to us, but some don't. And we always offer, hey, we're happy to do it. And some of them like, no, we have an in-house team that does it. But I found that that's an area that a lot of buyers think that the transaction attorney is deeply involved in, and quote, they've got it. But I found that on the accounting definitions portion, the transaction attorney typically doesn't have a CPA or doesn't have that background.
Yeah.
And they're not deep in what our QOV, working capital, and debt actually looked like in the schedules we provided. So oftentimes the negotiated legal terms do not match the data book that we provided on indebtedness, working capital, and quality of earnings. Quality of earnings usually does, because it's usually a multiple off of an EBITDA number, right? But debt and working capital, you often go in there and you're like, hey, we excluded this and we put it in debt. You guys still have that in working capital. Like, let's say you treated deferred revenue as debt, and like you go in and deferred revenue is still defined within working capital, because that's quote how every deal does it, and that's how the transaction attorney just put it in. But those are areas where I think value, you get down to the 5th yard line, and value can be lost because you had a great provider doing all these things up to the point, but if it doesn't get in the legal document, it doesn't mean anything. Yeah, it doesn't matter.
That is so good. And that's exactly why, like, one of the biggest pieces of advice is, not just build your deal team, but build your deal team with people who are used to working with each other. Because for that very reason, because, your accountant is not a lawyer and your lawyer is not an accountant, and they need to be on the same page with the terms that they're using, so that what is reflected in the purchase agreement reflects what you did in the QOV and what you've actually agreed to with the flow of money. And you're exactly right. I mean, if your QOV provider and your attorney are not on the same page, they could simply be identifying those terms, like what is actually included in working capital, what is included in accounts receivable. And if they don't use the words right, then those words mean something completely different in the purchase agreement. And that's how you can miss out. And so, man, that is real tangible, like, example of why it's so important to make sure that your deal team knows each other and they're working together on your behalf, not just doing their siloed piece.
Right.
Wow. Excellent. Awesome, Jonathan. Well, hey, I appreciate you sitting down with me and really kind of walking through the fundamentals of financial due diligence, and how, first-time buyers, the things you should be looking for, and how we can be better prepared. Going forward, if someone wants to work with you, for either financial due diligence, they have questions about QOV, how can they get in touch with you?
Yeah. So, you can always reach out on LinkedIn, Jonathan Hutchins at Ascenti Partners. Email is jhutchins@ascentipartners.com if you want to shoot me a note. Happy to give you my cell phone as well, if you drop me a note, and, happy to pick up a call and discuss what I can do. But we've got a team of us. I'll give you just the snippet background. There's about 25 of us across the U.S. that do diligence. I'm one of the folks. A lot of us are kind of ex Big Four folks, across a breadth of industries. So pretty much any industry you are looking to do outside of some really deep healthcare stuff, we can provide you the expertise you need. But we'll be happy to assist in any capacity. And we do a full breadth from cash proofs all the way up to full blown, deep report and Excel deliverables, based upon the kind of the needs, whether it be an ETA buyer up to a sophisticated strategic or private equity. So
Amazing.
Happy to help.
Awesome. Well, thanks so much, Jonathan. I know this is going to be super helpful, especially to, first-time searchers, really getting a grasp of, like, not just the importance of the QOV and financial due diligence, but who they can talk to get their questions answered. So thanks again, Jonathan. I really appreciate it.
Jed, appreciate you having me on.